Hi, and welcome back again to UOA. Today we'll be taking a look at a couple vol capture trade ideas. This on ASTS that has seen big repeat call buying, to say the least, big spike in implied volatility. So taking advantage of that volume and volatility that we always like to on our vol capture trades to uncover trades with edges. So let's jump in and take a look. First, here's the day of the really big volume beginning. This is from the middle of August, August 16th. You can see the September calls saw huge volume in the out of the money that became in the money, right? September 30 and 35 calls as thousands traded there. Certainly had decent volume before, but nothing like there. You can see November seeing massive volume as well. Going out to January of 2025, seeing big volume there too. And even going out all the way to January of 2026, seeing big volume there. So we started to see big volume in ASTS, AST Space Mobile. They're considering getting into the kind of satellite race. Certainly, when you look at the chart, right, this is all post earnings, by the way. You can see it became kind of a meme light stock. Certainly has been hitting up on all those boards. But all this buying is certainly post earnings, right? But we're seeing implied volatility pick up dramatically. We did see it start to level off until we fast forward to September. We can see just a few days ago some big volume starting to reemerge here. We can see October starting to see volume again, seeing September some big volume there as well. As we keep kind of going through, you can see a continuation of the volume that did spike the implied volatility further. How much did implied volatility spike? Pulled off a couple vol charts. Here's a simple one going out 360 days, so a year out, right? On the 25 delta calls, you can see for the most part the stock IV pretty well behaved here, hanging right around that 110 level, give or take. Then with that big call buying coming in that we just took a look at, right, a huge spike in implied volatility, now trading up towards 160. So a massive spike in IV, to say the least. This sets up ideally for those vol capture trades, right? Selling implied volatility in a measured, somewhat delta neutral fashion, take advantage of this massive spike in implied volatility caused by that big repeat volume coming in and looking for a mean reversion back. Very similar to what happened back here. Took a longer term look, and ASTS has been around for only several years here. So this is in the entire history of that basically year out IV. You can see we did see these spikes here on earnings, right? Immediately revert back. That's what we're expecting to certainly happen again. Take advantage of the reversion of these big spikes. This one went through the roof as far as IV, so we're looking for certainly a reversion back down. You can see current IV percentile at 100%. All that means that volume has caused the implied volatility, i.e. the price of the options, to get to the highest price they have been over the past year. So that's set up for a couple trade ideas. One of them is simple straddle. I went out to actually January of 2026. I prefer doing longer term ones on these kind of meme mania ones, because the short term ones, you can get caught if they decide they're going to gun this thing one more time, right? The shorter term ones will maybe have to roll and so forth. The longer term ones, you have such a nice cushion, you can just wait for that reversion. So taking a look at, here it is going, I took a look before the big volume came in on August 16th. This is going back to August 9th. And this is actually, posted as far as the earnings, right? Earnings, as we said, came out when we take a look at the chart, right? Earnings came out on August 14th. So this is pre-earnings. So this includes that kind of pre-earnings normal lift on IV, right? That normally reverts back post earnings, but you can see going back to August 9th, just before earnings coming out, right? The January 30 straddle that expires in 2026, right? And it's well out of the money. Stock closed at 22.32, so the puts are deep in the money. The call's well out of the money. You can see that straddle was priced just under 26 bucks, right? And trading at basically a mid, 115 or so IV. That's exactly what we looked at on that IV chart, right? Where we saw that it was hanging right around that 115 level. Here's the day we're kind of looking at right in here before this huge spike higher. Then post all that call buying, we can now see IV has leapt to well over 130. The puts nearly 135, the calls well over 130, and that straddle price with ASTS now moving closer to 30, ideally towards the ideal price, right, which would be near that $30 level. We see that the straddle price has increased by almost $5, right? It was trading just under 26. Now it's over 30. Why? Because of this huge jump in implied volatility. You would expect that to drop in price, right? Simply given the fact that it's moving closer to 30. Instead, we had it pop higher. So certainly one way to play it, looking for that reversion back towards that 115 level over the coming weeks. Can get a little bit further out of the money on both sides here. Here is the 1535 sell strangle, right, on August 9th. That's at the highest strike they had at the time, right, on the January of 2026 expiration. You can see that sell strangle going for just under 14 bucks, trading at, again, around that 115 IV, 117 on the calls, under 110 on the puts. Fast forward to after all that big call buying, right, Friday's close here, you can see that sell strangle, right, the exact same one, has exploded to over 19. So under 14 here, over 19 here, and again moving towards kind of that ideal price, which would be 25, right, in between 15 and 35. But this thing exploded by over 6 points. Why? IV now well over 130. Huge jump in implied volatility. Taking a look at it in a different context, right? Back on August 9th, you could have sold the 1535 sell strangle, right, for about 14 bucks, just under 14 bucks. If we go on Friday's close and instead of selling the 35 calls, give us a much bigger upside cushion, the 55 calls, even that would have been much more expensive. Instead of being just under 14 back on August 9th for the 1535 on Friday, September 6th, right, you would have been able to sell the 55.15 for over $16 again because of this huge vol pump here. So that's certainly a very nice way to take advantage of this as well. Doing it with plenty of cushion on this trade, to say the least. And this big spike in implied volatility, makes deltas even less pertinent. Another way, a little more, neutral, if you will, taking a look at the 2035 call spread, right? Going back before the big call buying on August 9th, as we have on the previous few examples, right? Selling the 20 put and the 35 call, could have gotten just under 17 bucks for it. Then on Friday's close, right, after all that big repeat call buying, right, that same sell straddle, right, would have jumped up in price. Yeah, the stock went to 26, right, but this sell strangle, right, is now smack dab right kind of in the middle here between 20 and 35. The midpoint is 27.50. We're still more leaning towards the put side, but because of this massive jump in IV to over 130, right, whereas before all the big call buying, as you can see, it's right around 115. That sell strangle, this time the 2035, a little more neutral, a little more bullish by selling those puts, now went from just under 17 to well over $22. So with the stock moving from 22.32, right, to 26.11, so a little bit less than $4. The sell strangle actually went up more than the stock did, and the stock went towards a better price for the sell strangle. So this huge jump in IV, once it tempers, and it inevitably does, you can take advantage, buy this back for a gain. So that's certainly a way we can take advantage of these huge jumps in implied volatility to position, and I prefer longer term, right? You can get out of the way of any short term shenanigans as far as goosing the stock price short term. Longer term, you have such a big edge. And again, taking a look, right, at our, for example, the 2055, if we decided to do that, right, again, it's higher than the 2035 was on August 9th. So this comparative, again, you can get 20 points further, out of the money and still get a much bigger credit. Yeah, not quite as good as the 2240 where you're selling the 2035, but by even selling the 2055, you can still get more than you could have for the much lower 35 strike, the 2035 strangle before all this big call buying. And also note too that your downside is basically zero on this trade, right? You're selling the 20 put, so you're bringing in 1940. You have 60 cents of total risk if ASTS goes bankrupt, goes to zero, right? So your downside virtually zero on this one. Your upside break even is right around 75, simply taken by adding that almost $20 credit to the $55 stock price. The stock closed at 26.11, so you can basically have the stock over the next year and a half go up 200% and still get in trouble. But the main goal of this trade, right, is to have this massive pop in IV that we have seen here revert back down, not all the way to 115 where it had been hovering, right? We always like to take it off at about a 66% reversion. So that would put us somewhere around that, 125 to 130 area. IV gets back there, we certainly can take this off for a nice profit. So hopefully this explains how we go about identifying trade opportunities, making, and taking advantage of huge spikes in implied volatility caused by volume, that once the volume dries up, right, you'll see that implied volatility start to fall. And here you have such a big cushion, right? 0 to the downside, 75 to the upside on this. Even on the sell straddle, right, if you did that trade, which has a much bigger credit of just over 30 bucks, your downside again, nothing, because you're selling the 30 put and you're getting over 30 bucks for it, right? So even if it goes bankrupt, you still don't lose any money. Upside break even is basically 60 bucks. Stock at 26.11, right? You can afford the stock to go up over 100% and still not be in trouble by the expiration date. Same thing on all of the strangles out there as well. For example, this one here on the 1535, right? You're bringing in almost just a little over 19 bucks. So the 15 puts, the stock goes bankrupt, you still make $4, right? And to the upside, you're looking at about 55. So all of these factor in the fact we're selling this huge implied volatility that has spiked to levels we have never seen before, right? And then once it reverts back, right? And even reverting back to this level here will give a very nice gain. So until next time, as always, here's the good trading.